In this video, we're going to be breaking down the 7 habits of highly effective capital raisers. Okay, so in my previous video, we went through the 7 habits of highly ineffective capital raisers. If you haven't watched that yet, make sure you click on this link. We'll put it in the description as well, so you can go and review that. This section is focused on what to do, right? So the 7 habits consider the core of your process and the core of your thinking about how you structure an effective capital raising process. All right, here we go. Let's go through the 7. 1, be prepared. The most effective capital raisers are prepared. They understand that as soon as an investor is interested in their business, there is a clock ticking on the time frame for their interest, and they're thinking to themselves that they want to get to the fastest yes or no possible. So they prepare the information, they prepare the frequently asked questions, they prepare a process and documentation and also the metrics that will be of relevance to an investor looking at investing in their business. That way, when an investor expresses interest, the information that they are looking for is right there for them. This allows them to get to a very fast yes or no decision, regardless of what it is. Okay, so that is the first habit. Second habit, they build awareness to relevant networks and also ecosystems for their opportunity. So in understanding this second principle, one of the best things for you to understand is it's very hard to sell a secret, right? So when people go to a capital raise, it's hard to raise money if no one knows about you or if people aren't aware of what you're doing. So the most effective capital raisers are always out there building their networks and building interest amongst people that are relevant to them or in their industry or in their ecosystem that can either add value or potentially invest into their actual business. So whether it be, as I said, specific niche industry that you're in, or whether it be platforms, or whether it be demo days, or whether it be whatever accelerator programs, whatever it is, there's a role for yourself where you've got to build awareness. And my favorite word to think about when you're doing this is you've got to build and you've got to manufacture serendipity, right? So building relevance and building awareness to the right ecosystem. Now, also, this could be startup media or general media as well. This is also another way of you of doing that, because what you're looking to do is you're looking for investors to know or have heard or be aware of what you're doing, right? Because it makes it so much easier for you to generate that interest and generate that awareness when it comes time to raise money, right? So that is habit number 2. Habit number 3, they take a relational approach to capital raising, which means they build relationships with the most likely investors. So instead of just meeting someone and then pitching for money, they're often building relationships with those investors 6, 12, 18 months before they actually go into a capital raise. Why? Because it's human nature. Humans want to invest in businesses and people that they know, that they understand, and that they've been given time and space to get familiar with, right? So there's nothing tricky about this. This is just simple human nature that when you're making an investment at this sort of size, and understand when investors are putting money into private companies, it's often, the fundamental rule we talk about in our sort of workshops is that it's harder to get out of a private company than it is to get out of a marriage, right? So think about that. Very easy to get into, but very hard to get out. So you need a relational approach because they're effectively marrying their capital with your opportunity, and they've decided to invest into your business rather than any other opportunity, right? So do understand that when you're building relationships with investors, right? So they take a relational approach. That's habit number 3. Habit number 4, they take an integrated and systematic approach to their capital raise. So the traditional model for some founders, they go out and they just pitch, and there's typically no strategy to it whatsoever. Haven't got any sort of integrator approach where they've got sort of analytics, where they've got intelligence guiding them, or they've got any sort of, they've got any sort of overarching strategy behind their actual capital raise. They literally just launch their capital raise and then start sending out their pitch decks to people and then hoping they can get opportunities to pitch. So when you're thinking about this, you really want to be taking a 6, a 12, an 18, a 24-month approach to your capital raise. And in fact, one of the best times to actually raise money is actually when you've just raised money, right? So as I said, when you're taking a systematic and integrated approach, when you understand that your website is part of your approach, your social media is part of your approach, your communications with your clients, your suppliers is also potentially part of your approach. It is integrated because we all know one thing, and that is the right person, the right company, the right entity can make a strategic difference in the trajectory of our businesses. So we're always working towards that one person that can make a massive difference. And hence why it's taking an integrated approach or a systematic approach helps create those opportunities for you as a founder. But also in doing that, you get intelligence, number one, and also it gives you control and confidence over the process as well, because you're actually manufacturing it and you're actually driving it and you're working to a structure. All right. So that's the next one. So that's number 4. Number 5, they set milestones, right? So you set your targets for, 3, 6, 12 months in advance. You achieve milestones and then you communicate said milestones. So all too often what happens is founders will talk about what they're going to do, but often they never communicate with investors about what they've actually done. They don't often not communicating their growth rate. They're often not communicating new investors coming aboard. They're not communicating their milestones achieved. They're not communicating, new big contracts that they've won. So all these things become really helpful, or awards that they've won in the process. All these things become helpful for milestones that you set and that you deliver upon. Some of them could be even product milestones that you said you were going to achieve, right? So for all those elements, what the most successful and highly effective capital raisers are doing is they're communicating what the milestones are, and then they're communicating the successful achievement of those milestones. I can assure you, in promoting capital raises for the last 12 years, right, nothing generates interest like traction. Nothing generates interest like achieving milestones that you said that you were going to hit. And often it takes people that previously said no to you may suddenly want to become investors in your company. In fact, in another video, we talk about how people that have previously said no to you can become some of your greatest opportunities going forward. Okay, next one. Now, there is a subset to that, right? And that is that we just like to highlight to people that no one is entitled to raise money. Right? We're always working towards the opportunity to be invested in. And that should always be the psychology for you going forward as a founder. Okay, number 6, they value investor relations, communications, and engagement. Right? So when people are taking the transactional approach, they in their mind, they're jokingly saying to themselves that I want investors to put in money and then never hear from them again. Right? That is the absolute worst way to go about it. Said investors they're very fortunate in that when they get to see anywhere between 15 to 30 opportunities a month, right? So for every company out there that thinks that they're the only one in the world doing what they're doing, they would have met 4 companies that are doing exactly what you're doing in the last month to 2 months beforehand. Right, so they have this beautiful helicopter view. So they've got a perspective that we don't when we have got our blinkers on, absolutely driving hard, driving forward. Right, so successful capital raisers value that feedback from investor relations, or they value investor relations as a principle, right? Because it's strong communication, it builds relationships with the investors. Secondly, they value that communication and engagement with investors because of the feedback and because of what they get to experience as part of it, right? And sometimes that feedback or the ideas that they get can be transformational. Now, habit number 7, my absolute favorite, is that they're curious and open to suggestions, right? So often when you want to go and talk with investors, you want to basically put your stake in your sand and say, we're doing this. Right. And often what happens is when people get negative, they get critical feedback or they get rejections, they almost get insulted by the feedback that they receive. Right. The most effective capital raisers take on board these suggestions. Now, not all of them are going to be relevant, but some of them can actually transform your business. For me, I've had someone who's become a friend and a mentor. In our first meeting, he sat down and straight off the bat, he told me how much he didn't like my business model. And I was like, okay, so that was an interesting start. And then for the next hour and a half, he explained to me why and explained to me what he liked. And it's crazy how much that conversation has actually changed the way I think about my business and strategically the difference it's made in what we're doing as a company, right? So These are the summary of the 7 habits of highly effective capital raisers. So what I'm going to do is I'm going to go through again. We'll put them up on the side here. So first one is they're prepared. They have everything ready for investors that they're going to be looking for. And I'll add another little anecdote to that is if you get asked a question twice, make sure that you have that covered next time, either by documentation, by a process, or by a frequently asked question. Secondly, they build awareness to the right networks of investors and also ecosystems. Thirdly, they take a relational approach to raising capital and to investors, right? Very, very important. Fourth, they take an integrated and strategic and systematic approach to raising capital. So they're not just doing one-off here, presentation, pitch. They've got a systematic and it's integrated across all different assets of their business, whether it be websites, previous investors they've pitched, whether it be social media, whatever it is, it's completely, I said, it's a holistic approach to how they're thinking about their capital raise. Fifth, they set milestones. They achieve milestones and then they communicate the achievement of milestones. 6, they value investor relations, communications, and also engagement with investors. And the 7th is that they're curious and always open to suggestions. That there outlines the 7 habits of highly effective capital raisers. I hope you found that valuable.